some time there towards the end to get to every question. We've got just a little bit of content to get through here. We've left ourselves with a good 10 minutes there at the end to go through any questions that pop up throughout. So we've got more flowing in now. I'll just leave it another minute or so, so a few popping through, and we'll look to get started. Okay, look to get started. Hello everybody and welcome for those that have joined us so far and those still coming in. Welcome to our first business partner exclusive event for 2022. We hope you're all staying as dry as possible. It's been a testing time for the nation yet again, a large proportion of the nation at least, and we hope you're all as well as possibly can be. Thanks for joining us. We know that you're all very busy at this time. We're getting that feedback consistently, and we value your time very much. It's very precious to us. So thanks for spending it with us here tonight. What we'd like to do throughout the year is have a few different opportunities like this where we can talk to you a bit more informally, where we can give you basically a cut to the chase update on where things are at. We know that as business partners of ours, you're more advanced when it comes to the property investment space than the average client that we're typically working with. So tonight, what we'd like to do is really cut through to the chase of the recent data and information that's come from our most recent investment panel meeting, which was in February, just last month. So it's 2021 was certainly a turbulent year for the property market. I'm sure most will agree with that. For the most part, in a good way for most investors and homeowners. It's been a year like no other for Meridian. There's nothing that drives Meridian more than the success of our mutual clients, and throughout 2021 we had more than 1,000 clients' property investments very well placed to benefit from the substantial uplift in what the market generated over that year. Some clients' properties appreciating more than 40% in 2021 alone. So it's been a very strong year, but with a strong year like that comes quite a few shifts in the fundamentals that we look at from a analysis perspective. So tonight, we'd like to keep you updated on where the markets are currently positioned, what's changed over the past year, and I suppose what's to expect moving forward. We look forward to helping your clients to make informed decisions with the most up-to-date information and data available, and ensuring that you're up to date with that same information that we're sharing with them. Okay, so obviously tonight I'll be one of the speakers. For those I don't know, my name is Adam Duffy. I'm a partner here at Meridian. I'm the head of the property consultancy team here at Meridian. I've been with the business now for nearly 11 years, Glenn.
Yeah,
time goes quick. You're having fun. And I'm joined, of course, here by Glenn Piper, our founder and CEO. Hello, Glenn.
Hi, Adam. Welcome, everybody. As mentioned, I'm Glenn Piper, founder and director of Meridian Australia. It's been a successful 11 years for Meridian. We've been fortunate enough to align ourselves with some of the smartest minds in the property industry, especially in the property economic space. And that's been enabled us to position clients in the right locations at the right time to see a lot of success in their portfolios. We're very pleased to have you all here. This is, as Adam said, our first business partner exclusive event. We are running a client-facing event in 2 weeks' time, which we'll go into a bit more detail. We understand, as Adam said, that you are more advanced in the investment space, so we're going to cut straight to the chase today. So, Adam, you want to kick us off?
Absolutely. So this is the agenda. Over the next 30 minutes or so, Glenn and I look to cover off on this content here. So there are a few new business partners here with us tonight. So we wanted to briefly chat about the research process and analytical process that Meridian goes through to identify the right market to be investing in. But then we'll be jumping straight into the update on where the markets are right now, what's expected to come from the markets over the next 2 to 3 years based on where the fundamentals sit. I think you might be surprised there by some of the forecasts and what's expected moving forward. And also, we'd like to keep you updated with what we're currently recommending with clients. So we've got a cross-section of properties that we're discussing. We want to take you through a background on what they look like from a price point, market and cash flow type of perspective. And then we also want to finish off by talking about a new engagement strategy, the 3 key strategies which we look to maximize that synergy between our business, Meridian, and your business, and most beneficially assist your clients. So without further ado, for those that are here today, I'm sure that you're aware that what lies at the core of Meridian is our belief that property analysis is really the key to identify a high performing property investment. So it's without a doubt that's at the core of our business and what we really look to utilize to make sure clients are making intelligent property investment decisions without emotion, but driven by the data and the facts. And that's certainly benefited clients over the years following this process. And very unique way that Meridian approaches research begins with what's called an investor panel. And this investor panel is built up, like Glenn said, with some of the most brightest property economic minds in the nation. These have been handpicked by Meridian over the years to build this panel and make sure that our clients are being directed by extremely intelligent individuals. All of these panel members, importantly, are unbiased. They're unrelated. They really have no drive behind recommending any property market at all. They're economists. They use numbers to make those decisions for them without any emotion attached. They all have strengths that they bring to the table, which is why they've been handpicked by Meridian to join our panel. And together we come to a combined decision about where clients should be focused at the moment and why. Rachel and Sarah, they specialize right across our model. Angie, a lot of the data we'll be going through, especially from a forecasting perspective, will be from Angie. That's where his specialty lies. Terry, KPMG, specialty is really in the analysis of infrastructure spending and how that impacts the property market. Tim's from Sydney Uni, his specialty is from a macro level and looks at things right across the globe and how global events can impact the property market. And over the past few years, it's been such an important part of our analysis process. Things like COVID, you've got multiple things going on at the moment across the globe that are affecting things. So his input is invaluable there. And Don Smith really specializes in the analysis of supply and how that can impact the property market. We obviously want to target areas where supply levels are low moving forward. So our business partners will be well across this analysis model that we go through. We make sure, as you know, your clients are very well versed across this model and exactly how it works. We make sure we're educating them with this entire process of how to look at a property market well before we're looking at any individual properties for them. But our panels sit at the very top of our research process, and we work with them literally like this funnel suggests all the way down. We meet with that panel 3 times throughout the year. Like I mentioned at the start, the introduction here, we've just had our most recent meeting with them in February, and there's been some really interesting data that's come out from that. So we're looking forward to sharing that with you today. For us, we're very strict and always have been in relation to those macro fundamentals that sit there, and they need to be there at every single level before we're taking the step to the next level. So a suburb simply needs to have that strong economy, consistent migration movement into the area. We need to see infrastructure spending occurring. We want to see a high dominance of owner-occupiers present in the location. Rental yields need to be strong to generate a strong cash flow for all of our investors, typically looking to invest in multiple property over time. Supply, we want to see vacancy rates low. Remember, below 3% is a good vacancy rate. Below 2% is a great vacancy rate. That's where things should be right now. Anything above that would be cause for alarm. Future supply, we want to use BCI to analyze and make sure we're investing in markets where there's not a risk of too much houses or too much apartments or townhouses coming into that area as well. So BCI and Don Smith's gives us that crystal ball there that we can have. The availability of credit just talks to the lending environment, and the majority of business partners we're working with, being mortgage brokers, are certainly affected firsthand by that changing credit environment, and as is the property market. And finally, their affordability, we analyze that very closely, and that's been one of the fundamentals that's substantially shifted, especially over the past 12 months, which you'll see here. For us, the market needs to illustrate strong affordability to give us confidence that it can perform and grow over the medium to long term. If affordability is not strong and it is representing a market that has high risk, we need to be avoiding those areas. So we'll share with you, like I said, the cut through to the chase to the important data on where the markets are sitting right now based on those fundamentals. But once we've found a suburb that meets all of that criteria for us, then we're looking for the property. So tonight we'll take you through a few and illustrate why they're investment worthy markets and what type of properties suit those particular markets.
Thank you, Adam. And I'd just like to touch on the model that we do use. The process of taking our clients through that does increase the rate of success with our clients. So we really do want to make sure they're educated, they understand the data that we're talking about. Otherwise, it's really just not going to be, it's not going to sink in, and they're not going to be able to make an educated decision. So this information we're sharing with you today, we'll also share with your clients, and we share with our clients on a regular basis.
Yeah, but I think it's usually with a client, it's elaborated on a little more than what we will do tonight. We know that, like we said at the start, you're more advanced from a property investment understanding. We make sure our client is completely across the entire process and all the data and numbers before they're signing the dotted line on a property investment for themselves that we've recommended.
Okay, so 2022, let's take a look at some of the data that's been released. Here we have from Charter Keck Kramer, which is source of ABS. We're looking at overseas migration. Used to be one of our strongest fundamentals in the property market, but obviously with COVID, that's taken a turn. And not only are we not seeing any overseas migration, we are actually seeing negative overseas migration because people are returning home to the countries with less restrictions in place, or they want to get home to their family or whatever it might be. So it is very interesting to monitor this trend, but yet the property market has still performed in certain areas. So as Adam said, it's about each and every one of those fundamentals. It's not just about one. We would never say we don't invest in an area because there's no overseas migration. That is just an indicator to help us assess the likely direction of property values, but also the rate at which it will appreciate or depreciate, depending on the fundamentals. Yeah. So you can see the ones that are hit hardest there, obviously being Victoria, which has had the largest decline in overseas migration. What I'd like to spend some time focusing on is interstate migration, because if you have been following the property markets, you will see certain growth in particular cities, and that can be cross-referenced really with an interstate migration, where we're seeing a pickup in demand since COVID has picked off. So here we have interstate migration. You can see Queensland is winning this race. It is over 30,000. We're seeing strong migration north from Victoria and New South Wales. We're seeing that's for a number of reasons. Yes, they had a better, would you say better management? Well, they had fewer cases of COVID, so that may have contributed marginally, but I believe the biggest contributor has been the affordability that Queensland has offered following the Victoria and New South Wales booms, which has seen a deterioration of affordability. And that has encouraged more and more people either sell up and move to Queensland and cash in on their home or investments in the other states, yeah, or they simply can't even enter the market, so they're moving north to enter the market and realise a similar income, yeah, up at our neighbour in Brisbane.
I think that too, combined with a bit more flexibility created in the workplace, and it has shifted the way people move around the country, especially people are now not only able to move to an area where there's a bit more of an affordable price point. Quite a lot of working from home now, so they're able to live in an area where the price point is lower, but earn a very similar income to what they earned before they left. So that's certainly added to a shift there as well.
Absolutely. And I'd just like to point out that Victoria was once the fastest growing interstate migration in Australia, going back, half a decade or so. And that's now changed dramatically. And we're seeing a big outflow from Victoria, which is unusual considering if you look at from 97 all the way back to 97, it hasn't seen as large an outflow that we're seeing at the moment. I'd also like to touch base on WA. So you can see WA in 2013 had some strong positive migration, and then we saw a big decline in interstate migration to 2017, and that was following a correction in the mining or the resource sector, which meant there were fewer jobs, which led to people leaving WA to source employment elsewhere in other states. But from 17, we've seen that decrease minimise, and then even with their hard borders, they've managed to record a positive for the first time since 2013. So that does definitely pique some interest and start to look at, okay, well, what's happening in WA? We know that property market has been flat for 15 years. Is something changing in that market, and is it time to start bringing some attention to WA, or in particular Perth? Interstate migration in New South Wales is strong negative, but that's pretty consistent. New South Wales, or Sydney in particular, has always relied on overseas migration for their increasing demand, and so since we haven't had that, it's been going backwards in terms of population growth.
Absolutely.
And shortly you'll see that in vacancy rates. You can also see on the other side of the screen, on the right-hand side of the screen, South Australia, which was having an outflow of around 4,000 people back in 15. That's trended up, and we're now into a surplus in South Australia. And also you're seeing Tasmania come back from its highs as well. So really a lot to take from this slide. We want to compare this to the other data, and in particular supply. So here we're monitoring vacancy rates. This tells a really apt story here. We were seeing Perth coming down from 5% vacancy rates in 2017-18 down to under 1%. Now that shows that migration, or that decreasing outflow and a lack of construction has really put some strain on the supply pipeline, and now well below 1% in vacancy rates. Queensland, or Brisbane in particular, much of the same. We're seeing a sharp decline from its peaks in 2017, which is obviously a very good thing for property prices and for rental market. We're seeing the opposite take place in Sydney and Melbourne, where it's been on an upward trend, in particular Melbourne, and you saw that large outflow of migration, and that has led to increasing vacancy rates, which is excess supply, which is that places downward pressure on the property market and on property prices. So it's definitely something to be aware of. And then of course, through BCI, we track future construction pipelines to determine if they're building too much or not enough. If they're not building enough, then vacancies will continue to fall if there's migration. If they're building too much, then vacancies will increase. So it's something we pay very close attention to. And then you can see on the right-hand side of the screen, all these cities are in very tight supply. So we're seeing a very positive in all markets really, except for Sydney and Melbourne in terms of vacancy rates. Anything you want to add there, Adam?
No, I think it's worth making the point. In particular, if you look at Melbourne and the uptrend, the sharp uptrend there, it's because it's a combination of both the loss of population from an international migration and interstate migration, but at the same time, in certain areas of Melbourne, there's been a construction boom where you're seeing, thousands of new dwellings come into certain areas of the city as well, which has made this exacerbated the worseness of that graph there. So this does look at things from a city perspective, but there are certain suburbs we saw vacancy rates get to 9% in that we're looking at from an analysis perspective. And And again, in Brisbane and other markets where you've had the opposite equation, you've had all these people moving in and there's no way for new supply to enter that market. Vacancy rates are sitting below 1% in certain suburbs we've been looking at of late. So now it's been very interesting seeing the turbulence of these numbers.
And let's not forget that the vacancy rates we're seeing in Perth and Brisbane today are at the same levels, if not lower, than Sydney and Melbourne before their booms.
Yeah, absolutely.
So we've just got a question coming here. With high vacancy rates, then do prices fall? They can. It definitely has the most impact on rentals. So rentals will not be increasing and can decline. And depending on the future supply pipeline, it can lead to a correcting property market, yes. But there are other factors which will probably have larger impact than just vacancy rates alone, which we'll get to in a moment.
Yeah.
So again, just on that point, Brisbane and Perth at the same vacancy rates, if not lower than where Sydney and Melbourne were before their booms.
Yeah.
So probably the one for most discussion and the one having the biggest influence and downward potential or risk, the thing creating the most amount of risk in Sydney and Melbourne is the affordability. So affordability is calculated by a percentage of household income spent on mortgage repayments. Again, this is coming from Charter Keck Kramer. And what we're seeing is Sydney is currently at all-time highs in terms of percentage of household income spent on mortgage repayments. Now that is a dangerous sign, considering that interest rates are the lowest are on record, 0%. And there's indications of interest rates will increase over the next 1 to 2 years. It's anyone's guess, but there's definitely going to be upward pressure on interest rates moving forward. And we're already at a position where Sydney-siders are spending the most they've ever spent of their incomes on the mortgages. So that is definitely a high risk profile, and it's probably the most alarming statistic that we have in today's data set. And also, when we're looking at Melbourne, while it's not at record highs, it's at the peak. It's at 36%, and its peak is 38, 37%. So it's right there, which means there's not much more Melbourneites can afford either on property prices to spend on their mortgages. Seeing far higher affordability levels, we can see that in Brisbane and in Perth. So you can see the blue one being Brisbane. It's under 25% of household income spent on mortgage repayments. That compares to 41% in Sydney. Back on Brisbane, and 25% compares very well to where it was in its previous boom, which was all the way back in 2008. That was the last time Brisbane reached the peak of its boom, and you can see that the numbers there, 33 to 34%. So still a lot of affordability left in that Brisbane market, despite strong uplift in the last 18 months. Then when we take a look at Perth, of course, the last time it boomed was way back in 2004. And its affordability got to 35%. And right now we're seeing Perth down at 15%. So less than half of where it was previously. Of course, the economy is not as strong as it was back in those times with the booming resource sector, but it is definitely a positive for the Perth property market. I just saw a question come in. I'm just going to open that up. Why is Canberra only one graph but not the others? Good question. So we've seen Canberra is definitely included on this affordability graph, but not on the previous graph. I believe the others were state orientated, but we can get you that vacancy rate for Canberra. That is not difficult for us to do. This is, again, come from Charter Keck Kramer. We can put that request in for you. But the vacancy that we missed on Canberra, we know it's extremely tight over there in Canberra as well, 1% or less.
But an important market in Canberra from a difference in stock perspective, because on the apartment side of things, you're seeing a much higher vacancy rate than you are on the house side of things. So, and again, there's big shifts between certain suburbs of the Canberra market. I won't elaborate too much more than that. We can chat chat further on Canberra personally, but it's a very interesting market when it comes to the vacancy rate.
Yeah, one of the concerning factors for Canberra is its recent run in property prices. So it's taken its affordability. You can see on the right-hand side, the blue line, Canberra getting up to close to 20% and its peaks being 25%. So not too far away from its peak affordability levels. And let's not forget where where interest rates, mortgage rates were back in 2008. We're nearly at those levels, and mortgage rates back then were, I remember having a mortgage at about 8% for a mortgage. So, and currently we're seeing mortgage rates in the 3s. So it is a concern for any market which is getting close to the top of their affordability and where they've been in the past. You can also see that in Hobart, not far away from its peak. Darwin, very affordable. You can see that as well, down at 10%. It has gone through a correction over, if you're talking over a medium term, definitely been a correcting property market, again, affected by the resource sector.
Yeah, I think it's a first time in a long time where Hobart is, Hobart, for those that don't know, most would, but it's been an extremely strong performing market over the past 5 years. It's been a market many missed because it was looked at as quite a speculative area where certainly from an economy standpoint, fundamentals weren't extremely strong. It's not diversified or strong. It was other factors that drove the property market, which is a balance of all of these things. But now you're starting to see, for the first time in a long time, Hobart reach its peak from affordability standpoint, and you're starting to see a migration, interstate outflow out of Hobart as well, which is the first time it's had that in a long time as well. So that's another sign that the affordability affects where people are choosing to live, and that will
no longer an attraction.
Showing signs that Hobart had another phenomenal year, 2021. It's expected to start to slow that trajectory down.
So what I'd like to touch on is the type of conversations we're having with clients when we're presented this data. Adam's based in Queensland. I'm based here in Sydney. We have a lot of Sydney-siders, Sydney clients wanting to buy property in Sydney. And our discussion is we share this information with them. It's, guys, we're at peak affordability levels. It is unaffordable right now, and we have record low interest rates. Interest rates will not go lower. They're moving up in the near future. Where do you think is the best place to place your money? Is it here in Sydney, or are there other markets which are showing stronger promise based on actual data and statistics from Charter Keck Kramer and the likes of the rest of our investment panel? So it is it's a very strong topic for client to have with clients, but the interest level from them is very high, and they engage with us because we are sharing this information with them.
Absolutely. It's great to give them an education on all the markets, not just where they're from. That's what Meridian service is all about, is about opening the scope for investment for a client, no matter where they live. Our offices are in Adelaide, Brisbane, Sydney, Melbourne. Our clients are from all over the world. We're directing their attention to the right market based on the data, no matter where they may be.
Excellent. So moving on to the 3-year forecast. So the forecast is done by Angie Zigomanis. If you look him up, he was named the most accurate forecaster in 2019. So he's comes very highly regarded, and these are his forecasts for the next 3 years. So what we're looking at is 2021 to 2024. We recognize 2021 financial year is almost complete, but this is the data. He updates this every 6 months. So if you see that graph, you can see Sydney is 6.9%. Now you might be thinking, well, hang on, Sydney's done more than that in 2021. Well, that's because there's correction expected in the following years. Then we have Melbourne at 2.8, Brisbane being the standout at 29.9%. And it has seen a lot of that in the past 12 months. We've got Perth at 16.6 and Adelaide at 25.5. Now, if we move over to the next, or the right-hand side of this table, we can see Sydney from December 21 to June 2024. So if you got in 6 months later into the property market, we're actually looking at a negative overall return. Obviously, the market's continued to go up in the past 3 months or so, but the forecast is looking forward in the following years, there will be a correction, and that will net out to be negative 3.5. negative 2.3 in Melbourne, Brisbane at 11%. And I always enjoy reading the commentary from Angie on this. And with Brisbane and Perth, the term is entering the growth cycle, whereas Sydney and Melbourne, it's at the end of its growth cycle. So from that, we expect that there's future growth to come because it has not seen, these two markets have not seen anywhere near the growth that Sydney and Melbourne saw from 2009. So there's potential for a lot more growth in these markets. But for this period, we're seeing a positive 11 and a positive 13.5 over in Perth. And Adelaide also recording 8.8%.
We always look to push for more time from Angie here, but as I'm sure you're aware, not many economists will put their name on things beyond 3 years, given what variables can change in that period of time. In fact, how many can change in a 6-month period. But this is where things look. Angie has a good reputation from a forecasting perspective because he was one of the only kind of economists in Sydney that were predicting Sydney and Melbourne to correct back in 2017 through to 2018 based on affordability, the lending environment, all these fundamentals that came through and actually drove both of those markets down. And he was very accurate too with these forecasts on uplift over the past couple of years. So when clients were first entering that COVID period and were concerned about the whole world falling apart, from especially the property investment perspective, then he had a lot of confidence in things were going. And obviously with the gift of hindsight now, you can certainly see things have played out in the right way. So like Glenn said, he's very bullish on Brisbane, on Southeast Queensland, and on Perth for a continuation from this standpoint from a medium perspective as well. Okay. What we'd like to do is also give you a bit of a background there on current property investments that are being discussed with clients. So we want to make sure you're armed with that information and are across why certain markets being recommended. So we wanted to have a look at a couple with you today. The first is actually in Perth, which is a relatively new recommendation from Meridian. Towards the end of 2021 and 2022, the investor panel in combination started to get quite bullish on the outlook for the Perth property market. And your initial thought towards Perth might be, well, it's been a correcting market. It's been one to stay out of for the last 15 years, and that's certainly true. Values are only just starting to get up to now where they were back in 2007 in Perth. And if you look at the fundamentals alone, though, which is at Meridian what we look to do, over the past couple of years, Perth's had the strongest economic performance in the nation as a city, number one. In fact, one of the strongest economic performances on the planet came from Perth as a Western Australian. Perth as a state and city. Rental yields from houses are the strongest in the country. Vacancy rates are the lowest in the country. Affordability is the strongest in the country of all cities. The price point for Perth back in 2007, I believe it was the most expensive price point in the country over Sydney. It is now the lowest in the country. So from a property investment fundamental standpoint, it's hard not to be excited about the current position of where Perth sits and start to get an understanding about why the panel, and in particular Angie, puts it as his most confident market, what he's expecting to come from it moving forward.
Just like to add on that, Adam, obviously we've been active in all markets and we haven't been active in Perth for some time. And we have repeat clients which have purchased 5-6 properties off us in as many years. And now bringing the conversation of Perth into the mix, there's actually a lot of excitement to be diversifying into another market. They're obviously encouraged by the statistics which support Perth, but we're seeing a lot of interest from our existing network that have exposure around the country, but not yet in Perth.
Absolutely. But as always, we need to be very particular about where in Perth and where in any city you're looking to recommend or invest. So specifically in Perth, you need to be close to multiple different employment types. This market we're looking at here is Hammond Park, 23 kilometres south of the city, 15 kilometres from Fremantle, another CBD, 5 kilometres to Perth Naval Base, 10 k's to Murdoch University, one of the biggest unis in Perth, 10 k's Fiona Stanley Hospital Precinct. So 9 minutes also to Coogee Beach. So in Perth, very important to have a balance of both the lifestyle types of benefits like the beach, the coast, the employment, though, is so important. Obviously, Perth and Western Australia is very a resource dominant city and state, but a diversity of localized different employment types is very important for the Perth market. Multiple schools and primary and secondary schools close by as well, which will lead to a very strong owner-occupier rate, which is extremely important in this market. So if you have a look, that's Perth, Coogee Beach just there, and Hammond Park just below it. It's an incredibly beautiful coastline. House rental yield sits at 5%. Vacancy rates are sitting below 1%, 0.5. Affordability is extremely solid. Owner-occupier rate for the suburb is very high. So for us, above 70% is, 70% thereabouts is extremely strong as a number. That's where we need to see it. Highly educated area, 39% have a degree or advanced diploma or above, and 36% of the workforce. It's a very white collar area, without a doubt. It's very professional, white collar, highest industry type of employment is employed by the hospital precinct close by. And incomes are very high. So just to give you an idea, that's the type of suburb where we're expecting growth to come from in the early phases of Perth really starts to lift. It needs to have a combination of lifestyle and employment benefits. The type of property that's most suitable in this market is without a doubt a house. A standalone house is very important. What we're currently recommending is a master plan estate, well positioned in the heart of Hammond Park. It's easy access to all the key amenities that it needs to have. We're targeting an area where those white collar professional families are looking to base themselves. A typical land size around 400 square meters. There's different options for clients, and the typical build size is sold at 200 square meters. And your prices, they range from the high 500s to the low 600s as your most common type of price point, with a rental yield or the rental return like this, 520 to 550 a week conservative. It's generating an extremely strong cash flow for clients. So when we run those numbers for clients and show them the ins and outs on what a house like this is costing, I haven't seen one that's cash flowing less than $100 per week positive to a client for a long time. So that strong yield representing a very strong cash flow to the client as well. So that's a strong option there in Perth that we're currently discussing with clients. Clients are currently investing in. Also, we're recommending properties in Brisbane. So Brisbane's a strong recommendation from the panel as well. Cross-section of different houses and townhouses specifically is where the focus is in Brisbane. At the moment, we're basically currently working on obtaining value for Meridian clients, and we're working on 25 houses at the moment that'll be exclusively available to Meridian clients. The details aren't quite finalised at the moment. We're looking to finalise those over the coming weeks, but price points will sit around 600K, and your kind of average distance to the city is around 25 to 30 minutes out of Brisbane City, but well linked to the coastal kind of areas of southeast Queensland. So there are options as well that we're recommending to clients in both the Perth and the Brisbane type of areas. Glenn?
So now we're moving a bit further north from Brisbane up to Caloundra West, Sunshine Coast. I'm sure you've heard of it. Beautiful location, beautiful part of the world, and a beautiful part of Queensland, Australia. We're very excited about this opportunity because we are the only investor group that is in this particular estate. It is incredibly difficult to get into this estate. And to the best of our knowledge, we are the only investment group in there. And we've been able to secure a great price point for clients that need something, sub 600,000, which is difficult to find in this particular area. So Caloundra West, 17 kilometres from Maroochydore Town Centre. There is a whole DDR or due diligence report on this property, which includes all the infrastructure plans throughout Sunshine Coast. Obviously, it will perform with Brisbane because it is so close, only an hour north. So that we are seeing with obviously the change in remote working, or the increase of remote working, that people are moving to Sunshine Coast and still working out of Brisbane. So we're seeing that. We're 12 minutes from the Sunshine Coast Hospital, which is an impressive new health precinct, which is employing obviously a lot of the medical staff. We're 17 k's from the airport. 10 kilometres to the beach, and that's Caloundra Beach. So that's just inland 10 kilometres. Sunshine Coast economy forecasted almost double by 2033. So Sunshine Coast is looking to build out their economy, build out their tourism, compete with the likes of the Gold Coast, and they are very proactive with their infrastructure spending. So at the end of this, if you think this would be something suitable for your clients, we will be launching this to clients in 2 weeks, but also you can send us a direct referral, and in there we'll have all the we'll provide the due diligence report, which will have all of the information you need around the infrastructure spending. Vacancy rates are 0.4%. As I said, it's extremely difficult to get into this estate. Owner-occupiers are just buying up everything in there. So vacancy rates are extremely tight. There's just not much rental property available. Rental yields are at 5 to 6%. Now in Brisbane, we are seeing rental yields come back because prices have increased so rapidly, and rents are increasing, but not as rapidly as prices. So rental yields we're starting to see pull back into the 4.5s, whereas what we're really attracted about and excited with this property, we're expecting 5 to 6% based on comparables in the suburb. But that also shows that we've secured a great price if we're able to achieve that rental yield.
Yeah, absolutely. It comes down to that price in this case.
Again, always focused on high percentage of owner-occupiers. For those new business partners that haven't heard us speak before, high owner-occupier rate decreases the risk because when there's volatility in the economy, owner-occupiers hang on to their property. So we're always targeting high owner-occupier suburbs, which this certainly is. So southern end of Sunshine Coast, so closest to Brisbane. You can see there the map in blue. It's a Stockland estate, which might explain why it's so hard to secure property in there. Stockland have a very good on-site sales team, and they handle all the inquiry. So hard for investors to get access to property in there. And they do actually make a rule that they can only have a certain amount of investors in the whole estate, which we think is a great thing. So you can see down there in the bottom left corner, that blue is the estate, and you can see all the different amenities which are included. They've obviously got all your local necessities with local shopping, with post office, etc. They're building that through this new estate. Australia's largest master plan community, establishing a world-class standard in sustainable community creation. 20,000 plus jobs on site itself, so they are creating an employment precinct. And if you look north of the blue, you're seeing orange and some other pink shaded areas. These are other employment nodes which they're building up as a part of the Sunshine Coast economic growth plan. 20 education and learning centres, 8 private schools, 5 public primary schools, 2 public high schools, 4 early learning centres. So it is not short on infrastructure. It's a lifestyle choice for sure, and it is in a lot of demand by those owner-occupiers for this reason. Really. Recreational parks, Stockland do a great job of that. If you've seen their estates before, they always make sure that it's a pleasant place to live. Retail centre, there's multiple retail centres actually in the estate, but there's a major one which this property sits in a short walking distance from. They're pushing for an owner-occupier product. They want that's who they're targeting for the entire estate. So as you can see, it's a very nice design, modern, attractive to an owner-occupier, and not a cheaper investment type build, which you may have seen in the past. This is definitely a premium property. There are only 12.
I think that's an important point here on some of the opportunities we've been working on of late. The best way we've been obtaining value in a market like this is negotiating in bulk. So in this case, 12, in the Brisbane case, 25 houses. That will be all exclusive properties to Meridian clients where they're not competing with that local market. The price has been negotiated directly by Meridian using those investors or using our buying power together to then present to investors to take advantage of. But that certainly worked in this case here as well.
lock up and leave style properties, so basically meaning low maintenance, and there is few of these type of properties in the estate. Majority are houses, so to have this price point available will be what's always shown to be in high demand. And you can even see online similar properties selling above the prices we've negotiated here. That is existing, not brand new. All homes have freehold titles, so it is not. There are no body corporates. Of course, some investors do not like body corporates, and this is no body corporate investment. So it is like a typical terrace where there is air gaps and spaces between each of the properties. Positioned in the heart of the estate, as I mentioned before, across from the village, the childcare facility, cafe, and shops. Internals are 146 to 182 square meters. Price points from 480 to 640. The mixtures of 2s, 3s, and there is a couple 4 bedrooms as well. Obviously, the 2 bedrooms being the entry level. Rents we are seeing at 520 up to 620 would be conservative. I'm definitely seeing higher numbers than that on those bigger properties that are in this complex. But that represents a fantastic yield. Excess
that's the 2 to 3.
5%.
That's the 2 to 3 bedrooms there. The 4 bedrooms have got a much higher rent.
Yep.
Those rentals.
There's only 2 of those 4 bedrooms, so if that's of interest to anyone, best to move quickly. Okay, sorry. So just summarising that. So we're just north of Brisbane and Sunshine Coast, Caloundra West. Great price point. It's a premium property, so owner-occupier style. So if that is of interest, then definitely have your clients register for the launch in 2 weeks, or you can send a direct referral to your consultant if you're already working with Meridian Consultant. But that's it on our stock for today. That's the 3 projects which we wanted to share with you all. There'll be more detail on the Brisbane one in 2 weeks' time for our client launch. But again, if you want any more detail, just reach out to us.
Yeah, absolutely. We'd strongly recommend any client you've got interested. Obviously, what we'd like to cover off in the client event on the 22nd of March, which will be advertised, already has been advertised out to clients. We strongly recommend any clients are invited from yourself personally. We'll be looking to elaborate a little bit more on this, the data that we've gone through to give them all an update on where the market's sitting today. And we'll go through all 3 of those properties in a lot of detail there. So for any client that's interested, that they can organise a meeting with us immediately after to discuss the properties that are suitable. But we feel that gives you a good cross section of the properties and areas that we're focused on at the moment. Houses well positioned in Perth, houses and terraces in Brisbane, and terraces here in the Sunshine Coast too. Some of these cash flow reports running on the rentals being so strong like this, so the strongest I've seen. You're getting properties that are almost up to the high 100s per week positive in cash flow, which clients are loving, or we're loving in our due diligence process on this at the moment. Okay.
So we'll move on just into engagement strategies. Adam, you want to take through the first 2, but we do have a new engagement strategy, which is a bit more advanced for those people who want to be more proactive and build that property referral side of your business.
Yeah, absolutely. There's 3 typical ways we engage in with business partners and their clients. They're all tailored towards the business partner's needs. We understand that all of your businesses are different and your client bases are different as well, and the best way to support them will be different. The first and most common way that we are meeting a new client of yours is through an invite to an individual consultation with a Meridian consultant, where we take them through the entire process from a first meeting, second meeting, third meeting of the education process and reviewing suitable properties for them and making sure they're across every single step. And of course, we, as a consultant, our team works with them through every single step of the investment process and beyond. The second type is a personalized education event. So this is where we run events every single month for clients. We're going to increase that to 2 events per month and slightly change that throughout the year in relation to the content that's covered, to keep it all fresh and new for clients, depending on which stage they're at from an investment standpoint. Like we've discussed, the next client event is on the 22nd of March, and we look forward to having your clients there in attendance. And the third one I'll let Glenn chat through. Is a relatively new concept for business partners to take advantage of.
Absolutely. For the client, for the business partners want to be more proactive and really build that this side of their business, being property referrals. We have a number of business partners, which it's a large source of income for them, and it's really ancillary to their main focus, which may be accounting or mortgage broking or financial planning. But they're really getting the most out of this relationship, and they're doing that by just being more proactive in promoting it and referring to the property side of their business. So this new strategy, what we're looking to do is increase referral revenue, of course, by just having a higher success rate with the amount of referrals coming through. Improve referral efficiency. So what I mean by that is taking less time to make those referrals for you, making it easier to refer any client that's interested in property to Meridian to discuss and go through our consultation process. There's also growing brand awareness for yourself. So what this engagement strategy involves is Meridian is willing for the appropriate business partners to invest into marketing collateral, which would be something similar to a webcast or a webinar, which is branded your business. So it's a webinar or webcast branded for your business, which you can use as collateral to make that referral process much more seamless and easier. And the webcast can include a number of strategies. What we've been doing to date is the business partner may have a topic that they want to cover, which may be around refinancing, and they can share that in this webcast. But then also it's property focused. So it's a webcast which is then referred to us as Meridian. And we will present much like what you've seen today in a bit more detail around the fundamentals and the specifics on property investment. And it's designed to be evergreen, something which you can continue to use, refer your clients to a link which takes them to this webcast, and they can watch, get educated. And if they like what they see, they can simply engage via an online form, which will capture their details for you. So because that will be branded the business partner's company, and we are invited as a guest speaker, it'll grow that brand awareness, and also it'll maximize referral conversions. It makes, obviously with us in the room via a screen, it makes that referral process a bit more successful because we can share the data that we've just gone through today in a bit more detail to give that client comfort to come make the call or drop an email to come along and meet with one of our consultants. So that is a new engagement strategy which you can speak with Warren Jacobs about. He will be your BDM, and just understand what does that involve, because we will be investing in your company, in your business, to create this collateral to make things easier and more effective for you and aligning with Meridian. So something we're very excited about. We're just launching it, and we hope that you take it up and it leads to more referrals for you and more alignment between our two businesses.
Absolutely. Every business is different, and what's going to be most effective as an engagement strategy will be different, but all three of those are very different. At the end of the day, what's in common though is we look to adapt them as best as possible to fit and connect with your business as best as possible to maximize the efficiency in the referral process, and then of course the conversion of the referral process so that it can result in the revenue back to the business and an effective and comfortable client experience. That's what this is all about. Absolutely. So thanks for everyone for joining us. Anyone that's interested in either of those engagement strategies there, the partner portal is just on our website. So it's very easy to jump on the website and get into the portal and refer a client either directly or invite a client into the next educational event, which in this case is in 2 weeks' time, which will be a great one for clients. And if you'd like to discuss the third strategy in more detail, you'll receive a feedback form directly to your device, I think 5 minutes ago actually, so that should be there with you now. If you'd like to just respond to that and let us know that there's interest, and Mr. Warren Jacobs or your BDM, depending on the state, will be in touch with you to discuss that strategy and how we can engage that most effectively for you. But thanks everyone for joining us today. We've gone only slightly over. We love to chat, Glenn and I. We hope you got a lot of value out of that. And like I said, we really do appreciate and value your time. Is there anyone that has any questions for now? Anyone that needs to jump off, feel free to flick a question in through the feedback form there as well, and we'll get back to each and every single one of you. I might just exit this so I can get to the chat section.
Yep, sure. Well, for those that don't have any questions, thank you very much. It was a pleasure to address you all, and we hope to do some more business with you in the future.
Absolutely. We've got here a point. Some of the data is September 2021. What is happening now? So 6 months. It is a turbulent moving time. Unfortunately, not all data is live. Even vacancy rates have a couple of month lag with them. And certainly being able to calculate incomes is something you're typically waiting on quarterly or 6 monthly data for, which comes through ABS or a source that's very reliable. Don't get me wrong, you can get income updates every month, but in our opinion and our panel's opinion, the data is not very reliable. So we want to wait for the ABS and the accurate data to make sure we're presenting clients with what's correct. Sorry, I've got some here.
Oh, yeah, here's some questions here.
Thank you. Thanks, everyone.
Anything caught up in the current floods is a question. Fortunately not. We always check that in our due diligence, that we're not in flood zones, and our properties, of course, they're affected by wet weather, but not being flood affected.
Absolutely. One of the very first parts of our due diligence process, I'm sure, as you can imagine, is the flood-wise maps and avoiding areas where there's a large proportion of flooding in the suburb or a property that's been affected by it in the past. Our clients have certainly benefited from that first step of due diligence on every single property that we look at, especially Southeast Queensland. Absolutely.
One more question there. Going back to affordability. Are our mortgage repayments based on interest only, or are they principal and interest? Well, it's mortgage repayments, which includes principal. It's based on a number of assumptions. It assumes a 70%, 70% LVR, and it's based on principal and interest on the interest rate at the given time.
Yep, absolutely. All good questions.
Thank you, Sam.
Yeah, thanks everyone for joining us. Like we said, we want to run more of these events throughout the year just to make sure you're up to date with the cross-section of the properties we're looking at and up to date yourself on some of that data and information. That's only from last month, that data. That's coming out. There have been some big shifts.
We knew that affordability level was going to be high on Sydney, but even we got the shock when it broke the record. So it is good to keep up to date with that data, and we look forward to sharing more of it with you. It doesn't look like we have any more questions. So good night, everyone, and we hope to see you soon.